Here are three things that you need to know to start your morning. Higher for longer is the name of the game, it seems. Fed Chair Jay Powell making clear that the central bank is almost done raising rates, but next year could see fewer cuts than previously indicated. The Bank of England, the BOE, also making waves this morning by leaving borrowing costs on a hold in a tight split decision. Now, that's the first time that they haven't raised the benchmark rate since November of 2021. It comes after a surprise fall in inflation.
We're on strike watch again, and there's some traction in Hollywood, it seems. Negotiations between screenwriters and studios resumed Wednesday and will continue today, with reports suggesting a deal-ending month-long standoff could be nearing. It's a different story, though, when you look at the UAW and Detroit's Big Three, with no breakthrough yet ahead of Friday's deadline. Stellantis has come to the table with a new contract proposal, but UAW President Shawn Fain has yet to greenlight it.
And well, the shutdown isn't averted yet, but the House GOP does seem to be making some ground in negotiations with holdouts. Embattled Speaker Kevin McCarthy proposing a new measure which includes deeper cuts, despite the fact that any offer is expected to die in the Senate. Just getting agreement on a spending proposal has proven difficult. The 30-day stopgap funding bill would set the current government spending level at $1.48 trillion a year.
Well, today's backdrop, the Fed is not the only central bank making decisions. We've got Switzerland, Norway, and England's latest rate decisions out today, and Japan later this week. Plus, there may be some movement on the front lines for the UAW and the Hollywood strikes. And there's that possible government shutdown less than 2 weeks away, a bit concerning here for the markets and the implications for the broader economy.
And so as we think about the markets, today's market driver, Federal Reserve Chair Jay Powell. The Fed held interest rates steady at a 22-year high on Wednesday, while signaling another rate hike will be needed later this year to bring inflation back to its 2% target. Fed officials see significantly tighter rates through 2024 than previously expected. JP Morgan Chief Executive Officer Jamie Dimon had a few thoughts on the Fed's latest policy decisions, as Dimon is expecting the Federal Reserve will most likely keep increasing interest rates in the coming months to combat persistent inflation. Dimon saying the U.S. Central Bank was, quote, a day late and a dollar short in beginning to raise rates. Now, we should note that some of these comments that came at the Detroit Economic Club were just ahead of the Fed's most recent decision, but still very much encapsulating how the leader and the head of the largest U.S. bank here is thinking about the Fed's action. And as we mentioned, saying that the central bank was a day late and a dollar short, but also saying that odds are higher that they will have to go higher than they are today. And that on the rate policy front, talking about 4 months from now, 6 months from now, that inflation will be at 4%, and it won't be coming down for a whole bunch of reasons. That also part of the commentary that Jamie Dimon had offered.
Yeah, we've heard a similar types of warnings here from Dimon, especially when you take a look at what he has said over the last 6 to 12 months, right? Talking about all the uncertainty, the headwinds facing the economy, and also the Fed's very tough fight here in trying to get inflation under control while avoiding a recession. Now there's more and more questions about whether or not the Fed is going to be able to do that, to orchestrate a soft landing if we're going to be in this higher for longer environment through 2024. So that is starting to really move the markets here this morning. We saw the reaction in the markets yesterday following that announcement, but it was a similar sort of narrative to what we heard from Chair Powell yesterday, right? Yeah. Chair Powell was routinely saying that we need to be very careful. I think careful was mentioned numerous times during the press conference yesterday, reiterating the fact that obviously the Fed remains data dependent. They're going to wait to see what the data shows them on inflation, what the data shows them on the job market, and continue to make those decisions off of the latest data points that we are getting. But still, we're in this very uncertain environment. And we're also seeing that reflected in the market reaction. When you take a look at the CME Fed Fund futures, yes, Powell was loud and clear, but the market, not every investor is buying what he's saying. Yeah.
One thing I do want to do, I want to go kind of like Dippin' Dots on this, if you will, and really dive into what some of that other commentary, and we've got a little bit of that from the head of the BlackRock Global Allocation Investment Team, as well as Chief Investment Officer of Global Fixed Income, Rick Reeder, over at BlackRock, saying that the median dots for the year-end 2024 suggest 50 basis points in policy rate cuts from the 5.6% median of the September projections for the 2023 year, end Fed funds published today. Now, that was less than the market had been pricing in, but the market has also backed up the 2024 kind of rate cut pricing by 40 basis points since the beginning of September. So all of this considered, the data from here, he's saying, will be the Fed's guide in terms of direction of travel, as Chair Powell suggested in his speech at Jackson Hole, as well as reiterating yesterday.